Hey there everyone, welcome back to the channel, and today we're going to be having our second part video on investing in real estate for beginners. Now if you haven't checked out the last video that we made, go and check it out because it talks about the first strategy that I find extremely useful. This video is going to be all about the second strategy that I find the most useful. And if you didn't see the video before the last one, check that one out as well. I'm going to leave a link right here in the cards to the last video. But the one before that also tells you all the things you need to know about real estate and different ways you can get creative in real estate. Today's strategy of real estate investing that I'm going to talk about is what's called compassionate financing. Now I found this method from going to a Kris Krohn event where he specializes in over thousands of homes, and he uses this exact method when getting his 25% ROI plus. Now at this seminar they went over step by step on exactly how this method differentiates from different methods that you can use in real estate, and why this is so great, because you can capture so much more in this type of real estate than you could in just renting or just leasing or even just capturing the appreciation in the home. So let's start talking about everything that you need to know for this strategy, because it is a little bit more technical and there are a few more things that you need to know about this strategy. However, the best part about this strategy is that it requires less work and less money for repairs and other things like vacancies that you would normally have to pay on a home. But first we need to discuss how do you know what market to get into and where you're going to get the most for your money. So when answering this question, there are two main things that we need to look at, and that's your macro and your microeconomics. So your macroeconomics is your large scale that you're looking at. So that would be what state you want to go into, which market is producing the highest returns. This is super important because not every market performs the same, and different markets have a greater return rate and growth rate. Next, you need to decide on your microeconomics. So that would be what county or what city you're going to go and invest in. You need to look at different aspects like how many renters are in this area, how many homes are residential homes, how many homes are investment homes, different things like that, and how nice the neighborhood is. Along with that, you're also going to have different appreciations from county to county or city to city. So you want to choose which county you want to go into by how much it's growing. Now these two factors are immensely important when you're looking at which markets are appreciating better than others and what homes will be appreciating more than others. Now the next thing you need to know is the difference between backyard real estate and out-of-state real estate investment. Now here's something that you have to understand. Out of all the markets in the US, you more than likely do not live in the fastest growing market. And that's totally fine because this method that we're about to talk to is more focused on doing real estate in your backyard than out of state. And that's for a few different reasons that we're going to be talking about. But you're eventually going to move out of backyard real estate if you want to continue to grow and learn how to invest even smarter and get even more out of your investments. So when you have enough capital, knowledge, and experience, you should start looking at what cities and what states are doing the best in their markets and where you want to take your real estate and move into a different market. But for now, backyard real estate is perfect because you're able to keep everything close and under control, and you'll be able to keep an eye on everything and not have to worry about it so much. Now with those things covered, we can finally jump into the strategy of using compassionate finance in the business of investing into real estate. Now one more thing, if I didn't mention, this is Kris Krohn's strategy. He invented this himself and he has worked through it through many years, and it's proven time and time again to work for him. Now what is so great about this strategy is that it allows us to take advantage of both main parts of real estate investing, which is the appreciation in the asset as well as setting up your passive monthly income. What happens in the strategy of investing is that what you're basically looking for in a tenant is someone who hasn't been able to qualify for a bank loan but is still an eligible and good candidate to be on time with their payments and eventually be able to afford a home. This makes your real estate very desirable because they no longer have to get qualified from a bank, and you become a different option for them to get into a home. This is what they refer to as seller financing in the business of real estate. Now, not to get confused, you don't want someone that's unreliable, never going to make their payments, and who is going to be a question mark as a tenant. You want someone that just hasn't met all of the standards for a bank loan, but is right on the cusp of it. Or they're making enough money, you can see that when you evaluate them. They've never had any bad dings to their credit or any history that you deem undesirable when you do a background check on your tenant. Because I'm telling you right now, if you don't do your research on your tenant, you're gonna end up with someone that's gonna cause you a headache every month when you try and get the rent from them, as well as maybe damaging the property and not listening to all the things that you set as restrictions when they move into the home. And that's a nightmare that you just don't want to deal with, and it's not worth your time. We're here to invest in real estate in a smart way that brings us the most capital. Now here's a few things you want to look at when you do their background check. The first thing is that you want to run their social security number. This is important because it'll show up any major credit dings or any history that they have that seems undesirable to you. The next thing that you want to check on is if they've rented a property previously. You want to get in touch with their landlord and see how well they did on keeping up with their payments when you ask for referrals from them. And one of the most important things is clarifying their income with them. So how much they're making, setting up your own debt to income ratio for what makes sense for you to allow them to come into the home and feel confident that they're going to make their payments on time every month and eventually be able to afford the house at the end. Which leads us to our next part. This tenant is going to be planning on purchasing the home after 3, 5, 7, or 10 years. This will be under contract, appreciation will be included into the contract, and you will make sure that you'll set a limit that the home cannot be purchased under. Now, why do we do this? We do this in case the market crashes or we have a swan event like we just barely did. This is super important because now your real estate property becomes much less likely to be affected in the event of a market crash. Now, as a side tip, you want to make sure the home that you're purchasing is under the average market value of wherever you're at. This is important because along with if the market takes a crash, you won't lose as much appreciation in the home, and it will take you a lot less time to make up your grounds in the rebuilding of your appreciation of the home. Now, back on track, the reason that we give the tenant 3, 5, 7, or 10 years till they can purchase the home, depending on what you deem fit, is so that they can have time to hopefully get the money for the loan or fix the credit for the loan or whatever their situation may be, just so they can qualify for a loan from the bank and eventually be able to pay you for the home. Now, because we're using a seller financing option, we're going to be acting more like a bank as well. So this means that your tenant is going to have to give you a down payment with this strategy, and that can range from anything that seems reasonable to you. Usually it can be $3,000, $5,000, $7,000. It can even get as high as $15,000. It really just depends on where you're at in the market and what you deem fit for their situation. But along with this, have different payment plans. So if they are able to put down more on a down payment, make sure their monthly rent is less than what it would usually be with a lower down payment, and vice versa. If they can only put down so much of a down payment, make sure that their monthly rent is more than what it would usually be. Now, just to be clear, on average, because we are seller financing and circumstances are different, from the very bottom payment plan you put, that rent monthly should still be $200 over what your home should be renting for monthly. Now, there's also one more thing you can do with this to ensure that they're happy and that everyone's getting a good deal, and that is you can offer credit for if they're making their payments on time every month. What this means is that if they make their payments on time every month, or for whatever you agree in the contract, you can agree to take either $50 to $100 off for each payment that they pay on time, or whatever you deem fit, even if it was $10. That would add up over the course of 3 years. This is another important factor to be considering when you're doing this type of real estate, because it makes the tenant feel more secure and like they're investing into something for their future by making sure that they're paying on time, and that it also gives you peace of mind as the property owner that you're not going to have to worry about missed payments or anything like that. And here's the great thing that is not involved when you use different strategies of real estate. Because you're putting a family in the home that plans to purchase the home one day, what do you think they're going to be doing with it? They're going to be taking care of it, they're going to be making sure that it looks nice and pretty, and they're going to be investing into the home so that one day when they do purchase it, it's ready to go, it's beautiful, it's homey, and it's exactly what they want. Now, you do need to make sure you set restrictions on how far that can go, such as remodeling and different things like that that they want to do to the home, because that is important to make sure that they don't do something that would decrease the value of the home dramatically. But because of this, you have a few different things that makes your investment secure. So for one, because you have a down payment from them, if they decided to pick up in the middle of the night and leave and not leave a note or anything and trash the home, you'll have that down payment to fix all those repairs, or even include for the vacancies for the next 5 months while you're waiting for your next tenant. And the next thing is that because they're taking care of the place so well and they plan on buying it, you're not going to have to pay for those repairs like you would if you were just renting a home. And also, you're not going to have to pay for vacancies because they're going to be living in the home for multiple years. Now, your next question might be, what if the tenant decides not to purchase the home after 3, 5, 7, or 10 years? Whatever you decided on in the contract. Now, that is an important question to be asking, but it's not going to be as big of a deal as you think it would be. Because if they decide not to purchase the home at the end of the years, then that's okay. You gave a great family a chance to purchase a home that could have made them extremely happy, and they were very happy for that opportunity. Now, you get to keep the down payment because that was in the contract, and there's no credit from paying their monthly payments on time that goes towards the purchasing of their home. That will be taken off on that market purchase price evaluation, and then you'll just move on to your next tenant and do the same thing over again. And even though you won't have the money that you planned on getting from selling the house, you can always do a cash out refinance and still continue your investing plans and invest that into more real estate properties. Now, let's say that they do purchase the home. It is very important that you want to make sure that all this cash is wrapped up into a 1031 exchange that you can invest into multiple other homes. This is because a 1031 exchange voids all capital tax gains when you sell this home, so you won't be paying taxes on that part of it. And with different strategies, you can also make sure that you're not paying taxes on any of your real estate. And that's another crucial point to bring up. You want to make sure that you have a fantastic CPA that's walking you through all the legal parts of investing in real estate, and that's making sure that everything you're doing is legal, to the point, and that it's documented for you, and that he's also finding you your best tax breaks that you can possibly get, as well as setting up a financial plan years in the future to make sure that you have a game plan for your investing. Now, capturing the appreciation comes in when you're waiting those 3, 5, 7, or 10 years. Because as those years go on, your home is only going up in value in the market. And then once you do that cash out refinance or 1031 exchange, that's where you capture that appreciation in the home. Now, this is the end for the second strategy for investing for beginners. If you had any questions, please let me know down in the comments. Otherwise, make sure to drop a like on this video and subscribe to the channel. Everything that you do is helping out, and I'm very appreciative of everyone that's coming back weekly.